I'm afraid there's no large follow buying in the bank Nifty. That becomes like a gray area for me. But the breadth is looking okay. Aditya Narain joins us. Let's take the conversation forward. Aditya, fantastic to have you back and thank you for joining us. Uh, I may use the word hyper because the hyper bull market continues both locally and globally. Uh, we saw numbness in mid and small cap stocks, but the benchmark indices are holding on beautifully. So, what's next? What is in store for the second half of this year?
Well, I would tend to believe that at some level you just need a certain amount of stepping back and consolidating. The pace of the market's expansion, I think, is far more aggressive than the economic rebound. And to that extent, unless there is an acceleration in the kind of economic rebound that one has seen, I would tend to believe that there should be a little bit of a consolidation, if not actually a little bit of a pullback at the market level. I think you did mention earlier in your commentary that this is a slightly split market in terms of, it's just not a one-way run. I think that is something that is even truer as far as businesses are concerned. And to that extent, I think there will tend to be a little bit of a normalization, a little bit of more outperformance if you get the right spaces than necessarily a one-way move as far as the broader market is concerned.
But hasn't the one-way move got challenged? Keep the Nifty aside, there are technical factors there. But I'm surprised that even though Nifty is at an all-time high, on average, small cap stocks have corrected 15 to 20%.
Well, we had done actually a very interesting piece about a week ago where we basically showed that over the last 15 odd years, there have been 4 occasions when the small cap index has got to about a 20% kind of premium to the large cap index, post which there has tended to be a pretty sizable correction. And that's the kind of place we had reached earlier in this month. So to some extent, if you were to just look at historical trends, I would tend to believe that this pullback is not an anomaly. This could have been actually forecast. I think that's one bit. I think the second bit is, what is happening with underlying businesses. And to that extent, while there has been, previously you would have a difference between the large caps and the small caps and then the unorganized space. Now what has tended to happen is because the unorganized has lost so much space, you've ended up seeing some of the mid caps gain in terms of from an underlying market performance, right? I would tend to believe that said, the larger cap businesses or the larger businesses per se continue to have a disproportionate share in the underlying business growth, which is not necessarily so for the smaller caps. And to that extent, as I said, there's been a market element that has seen this correction. I think this is actually true as far as underlying businesses are concerned. And so to that extent, I don't think it's been that much of a surprise. I think another area that one needs to really look at is the fact that India has outperformed the EMs very, very substantially over the last couple of months. Now, to some extent, when you have this kind of outperformance, it tells you that the global market effect is not there. There is something beyond the global market effect. I would tend to believe a lot of it lies in terms of the local market support or the local inflows that have come through, which has really created this differential performance and not necessarily the underlying economy. So bottom line, I'm not too surprised by what you've seen with the mid caps. I would not be too surprised if even at the market level, you see some kind of a pullback, not necessarily of the magnitude of what you've seen with the smaller caps, but a little bit of a pullback, I think, over the rest of the year, I think is a reasonably fair call to actually make.
Right. Aditya, just wanted to understand, in terms of a texture for the market going forward from here, do you really need to realign your portfolios? In the interim, it seems that banks have it all going for them. Do you now need to ebb off from IT, allocate more to banks, or do you think it's a rising tide and all will hold up well?
So as I said, I think the tide has risen quite a bit in any case. So I don't know whether you should continue to play for a rising tide. But the way we would position our portfolio, and we're not really switching it around given the performance that you tended to see. One is actually we would continue to be reasonably overweight as far as the IT space is concerned, even though stocks have moved very dramatically. And the reason for that is I think the business support you're tending to get there is actually phenomenal. I think the demand cycle for the next 3 to 4 years seems very, very comfortable. I think the supply side, where there has been a little bit of consternation in terms of wages going up and maybe a lack of availability of people, I think that should also ebb off over the next couple of months. So I think, particularly when you have markets that have moved a lot, what you really look for is a lot of comfort in terms of the underlying business. And to that extent, I think IT provides us that. And so we would continue to be, decently overweight. If anything, the very sharp rally in the market that we've seen, we would actually tend to believe a place where there is so much business comfort is a place to hide in the event of a little bit of a pullback. I think as far as the banks are concerned, I think that's a little bit more challenging. From our perspective, it is an overweight as we see it. We also believe that you're moving from the first phase of the economic recovery cycle into the next level. And so to that extent, the banks are going to be an integral part of that transition. And so should be an important place where you actually go out and play. That said, I think the one place that we would be a little bit more watchful is in terms of whether you're necessarily going to get enough bank credit demand for the next leg of the economic recovery. Conventionally, that's what always happens. It's a chicken and egg. If you don't get credit growth, you're not going to see the economy expand. And to some extent, you require that credit growth to see the economy expand. This time, I think in some senses, the setup is more or less the same. I think the difference could be a little bit at the margin, which is in terms of what is the nature of growth that you're going to get. Is it necessarily going to be fixed capital formation driven growth that is going to be the next leg? I think fixed capital formation driven growth at the end of the day is a necessity. In the interim, it could still be a little bit more services driven, a little bit more equity capital support driven, rather than necessarily, as I said, fixed capital expansion. But all in all, I think that's a space that we would remain relatively comfortable with. It's done okay in the recent past, but in a longer context, it's not done so well. And so to some extent, I think that's a place we would continue to stay overweight, even though that will be more variable and to some extent, a little bit more vulnerable if the markets come out substantial.
Just want to highlight and spend a few minutes on what's going on with telecom. Of course, three factors that really led to that big surge in Bharti, and the street took away with it. The fact that there was hint at a tariff hike, the fact that Sunil Bharti Mittal said that they're not going to be using the funds raised in the rights issue to increase stake in Indus Tower, the fact that he said that ARPUs are going to trend towards 200 rupees in this financial year as well, and also categorically saying that selling more promoter stake would be inappropriate and they have no plans to sell stake further. That said, there are already reports doing the round that perhaps Google is going to be investing into Bharti, and also reports, which is an ET9 exclusive, that Reliance Jio is going to be launching a low-cost smartphone in association with Google, much on the sidelines of what was promised by Mukesh Ambani on the sidelines of the 44th AGM, saying that he is looking at a 2G Mukt Bharat. Aditya, as strong as the prospects of it becoming a strong two-player market are getting, how excited are you about the prospects of telecom?
Let's just put it this way, that at the end of the day, that is the backbone of the kind of growth you've seen in the economy, and it's necessarily going to be the backbone of broader growth that you see in the economy. And the fact that it's fundamental or largely become a two-player market, at least in terms of incremental moves, just makes it a very good setup for stocks like these to do particularly well. I think the caveats are two. One is that it's not very clear how much of tariff hike or the direction in tariff hikes is in the control of Bharti. In many senses, it's a two-player market. One has to take the lead. And I think they've been a little reluctant to necessarily take the lead. So I think that from a timing perspective creates a little bit of uncertainty, or it lessens the confidence in terms of the term of the way the stock will tend to play out. That's one bit. I think the other bit, which is also, which you need to watch for from a stock perspective, is really the entire 5G rollout, right? Historically, whether it is in India or globally, whenever you've got into a next leg of technology, while it's been great for broader market expansion, right, and obviously for the efficiencies it provides, the reality is the incumbents are the ones who've actually have been forced to end up putting in a lot of capital, right? And that is not necessarily good for stock performances. Now, it does not mean that it won't be good for stock performances, but it is not capex of this nature. Given what's happened with India in the past, with telecom in India in the past, the market is just going to be a little bit more watchful. So I think we're in a good space in terms of the direction, in terms of the competitive flavor, and in terms of how Bharti and Reliance are on top of the sector, right? All of that I think is in place. But whether you're going to necessarily see this as the start of a long, strong cycle, I think the timing is a little bit of an issue. And so I think to that extent, I wouldn't say that, the next 3-6 months, this is where all the response is going to be in terms of stock market performance. But directionally, you're in a good place. And as far as yesterday's analyst call is concerned, I think, the management has very, very clearly laid out what their thinking is, what their action steps are likely to be. And I think they've also actually cut out a lot of the speculation that goes around a lot of these things. So I think a very positive development. Directionally, I think on a very good wicket. Exact timing in terms of how a lot of this plays out, I think that's a little slightly harder call.
Telecom, when it comes to making that first step towards increasing your pricing, it's been more a factor of how much pressure really do you have on your balance sheet, on your cash flow. Vodafone Idea, of course, the most vulnerable on that front, was the first one to take the price hikes, which gave almost an instantaneous breather for Airtel and Jio, and thus they followed essentially. Hi Aditya, this is Mubina as well joining in. I want to get back to the topic on banks, which you were talking about earlier. Now, within the banking space as well, like you as well mentioned, this is going to be about stock picking. How would you pick out banks? Would you want to go for the usual private large cap names, the Kotaks, ICICIs, etc., or would like to bet on, the smaller guys? AU Small, RBL, IDFC, there's a whole choice that you can pick from there as well. Looking at, the fact that there is hopefully going to be a pickup in credit growth, looking at what the asset quality is like, how would you pick out your banking names?
Okay. This cycle, I think, is going to be a little different in terms of how banks perform based on an upswing. Historically, what has happened is when you have a credit upcycle, it is the smaller banks, those with slightly riskier credit profiles, which tend, or slightly more aggressive approaches to lending, which actually lead the rally, right? And they can go on for quite a while, right? This upcycle or upswing, and we do really believe it will tend to come through, I think could be a little different, could be a little discerning, right? Obviously, the ones who are going to grow a little faster are likely to perform a little better. Those where balance sheet inflation will help them from a credit perspective disproportionately, I think those will tend to lead a little better. But I don't think smaller is better from a stock performance perspective, because I think what has happened in the last down cycle, and it's been a grinding down cycle, if I'm about to say that. I think what's happened is that the differential between liability franchises, between platform efficiencies, and between credit skills, I think that has actually widened quite a bit. And so you have a bunch of lead banks, right? And I'll say there'll be 3-4 of those, which are largely big, to be honest, right? Which have disproportionately gained over the smaller banks or the more challenged franchises, right? And so to that extent, unlike in the past, when an upcycle, as I said, would have the riskier ones doing much better, I would suspect you will still get, at the aggregate, probably greater outperformance from the leading pack in terms of size, in terms of franchises, and in terms of experience through some of these down cycles, right? So I think that's a broad categorization that, as I would see it, and that's what I say. I think there will be a differential in terms of how it plays out. I think within that, I think credit growth is going to be a differential element, right? So if you're a very high quality bank, but you're going to grow at 10%, and if you have a historically less high quality bank which grows at 20%, but now is fine from a credit perspective, I think the 20% fellow will do better than the 10% fellow. So I said two distinct buckets. I think the rallies will be different this time compared to conventional. Within those buckets, there will be a certain amount of difference. I think what I would also want to put in is in terms of even the kind of recovery that we expect. Previous cycles have been bust and then you have had solid booms. I think this time around, post the challenges that the system has had, you're not necessarily going to get a credit boom of the order that you've seen in the past. It will tend to be discerning. And so you're not necessarily going to get the banks as a massive trade unless a particular balance sheet revalues dramatically or a particular stock from a very low valuation comes back very, very substantially. So I might have run all over the place in terms of defining it, but I do think rallies will be more nuanced. They'll be a little different from the last time, but they do require that push up in credit growth, which is so far lagged what conventional recoveries tend to see.
Understood. Now, this is a sector, the auto sector, that's underowned, underperformed quite a bit. It's really been far away from that momentum trade seen in ITs, metals, etc. There's really it's a concoction of several factors that are playing out for the auto space. On one side, you have the upcoming festival season, which brings along with it the promise of better demand prospects. Not that, of course, so far it's not been good. It's been okay. But then on the flip side, the ability of these companies to be able to cater to all of that increased demand, because we are obviously facing a chip shortage situation. From the listed space, I know there are lots of names from the unlisted space, but we'll obviously stick to the listed space. Which do you think will be able to emerge from this chip shortage problem the best? How do you also see, and I'm going to roll the question into one because I know this is going to be an important component from your on, how do you see the EV play as well bearing on some of these individual stocks?
So, you rolled in a lot of questions similar to some of the answers I've given back to you. But let me just put it in terms of order of magnitude as I see, or order of influence as I see in terms of a lot of these spaces. One, I think the EV issue, right? Now, everything you look at, we've done a fair amount of work on it. In terms of the dislocation to the existing market in terms of EVs, I think that number is a little modest, right? That said, it starts becoming a little bit of an overhang in terms of longer term performance. Simply because if you're saying 8 years down the line, a large part of the market is going to be different from what you're doing currently, it does not support valuations. So I think that becomes a little bit of an overhang in terms of some of these businesses, in terms of how it's playing out. So that's one element. Structurally, I think it has become a little bit of an overhang for the space. I think the second, and this is an order of priority, I think the second is really, and I think it's not enough is being given, it's being focused on this point, is in terms of the demand cycle that you're seeing because of the dislocations on the consumption side in terms of income side, right? I think that's a little bit more challenging than what the market is reading into. Numbers have been soft, but there have been different explanations, whether it is a supply chain issue, whether it is chip supply shortage, or whether people are just seeing it as a timing effect, which will come through, once the pandemic lockdowns ease off. I'd be a little bit more cautious there, simply because I think there has been more dislocation on the consumption side for large discretionary items than the market is factoring in. So that'll make me a little bit more cautious, right? And the third bit is the chip problem, which seems extreme at this point in time, but I don't think that is really fundamentally going to change where valuations are going to be. It is a dislocation from a 3 to 6 month perspective, but beyond that, I think it will tend to settle down. So bottom line, if you take all of these into consideration, I think the demand issue will probably drag a little bit longer than the market is anticipating at this point in time. And so we would generally on that space be a little bit cautious. Where there is a certain amount of comfort is in terms of valuations. A lot of these, particularly the two-wheelers, have become much cheaper. Their cash flow profiles continue to be very good, and these are very, very competitive businesses, right? So overall, I would be a little cautious in this space from a demand-led perspective and less of a chip supply perspective, and I would fundamentally underweight it. Within it, I'd probably have a little bit more comfort on the four-wheeler space than the two-wheeler space. And I would look like some of the globally led companies in this space. Actually, I'd say they're probably better positioned than those domestically. And the same applies to ancillaries, where the demand from a global perspective just might be more robust than from a local perspective.
All right. Well, Aditya, it was a pleasure having you with us. Thanks so much for joining us this morning on the market.
Great. Thank you.